Welcome to F.A.C.E, David. It's a pleasure to meet you. If you could unmute. Not sure if you've been in Zoom before.
Yeah, I've been in Zoom. Can you see me?
Okay, who hasn't during the pandemic, right?
Yeah, exactly.
Okay, David, really, I want to thank you in advance for taking some time out of the trading day to be with us. And you're going to show your mug, so I guess I will do that too. Okay, so you're upside down.
Yeah, hold on a sec. This thing.
Okay. Oh, I should have taken some Dramamine before this interview.
Yeah, there you go.
All right, David, really nice to meet you. So, I understand that, your reputation precedes you here. Some of your followers are here, and they've already laid out your scenario for the S&P to go to 4,700, and then the bubble finally pops sometime later this year, third, fourth quarter. But you know what I'm interested in is how people ended up in the industry. Like, for example, I started after college as a runner on the floor of the CME.
Oh, really? Yeah.
Yeah, and then that was, that led to, getting to Series 3 and then going down on the floor and all of that, the long and winding road of, I've been doing this, I think as long as you, from 1976. So
Yep, you're pretty close.
yeah. So, we're not rookies anymore, and I'm just starting to get the hang of it.
Yeah, right. It takes a lot of time to make a lot of mistakes to learn from those mistakes, right?
Yeah. A veteran once told me when I first went there, and they looked at me like a piece of meat when I was going to go on the floor, said, "Kid, this is a tough way to make an easy buck." And they were right. So how did it begin for you, Dave?
Yeah, I got out of college in 1973. And back then, of course, it was Vietnam time. And I went into school as I was a declared finance major as a freshman. And back then, as you probably remember, people were going to college to avoid the draft.
Yeah, student deferments.
So most of the people at that time were, what we used to call hearts and flowers majors, liberal arts majors. All they wanted to do was be in school, so they didn't go to Vietnam. And I knew, for whatever reason, that I wanted to be in finance right from the beginning. So I majored in finance through college, got an MBA, got a job in a bank in the investment department right out of school. Again, I knew I wanted to get into the investment business. I went to a small school out in the Midwest, Valparaiso, which you probably know out in the Midwest. And so it wasn't easy to get from there to Wall Street. So I took a job in the college town. I was in a bank in Indiana at that time. Branch banking was only county-wide, so we were the largest bank in the county. And it gave me the opportunity to manage both bank portfolio and trust portfolio, so equities and bonds. And I attribute that, I was there 5 years, I attribute that as to my macro skills today, as I got the taste of both sides, got to work with bank liabilities, et cetera. So that gave me a lot of kind of the grounding. I got me my MBA from DePaul by commuting from Valparaiso up to Chicago a few days a week. It was a trimester system, so I finished in 2.5 years. I'd leave the bank at 4 o'clock, grab a Big Mac, and head down the Dan Ryan to DePaul, and I went from there to another bank in Connecticut. I grew up in Connecticut, so I went back east. I had to choose. It was a bigger bank, so I had to choose between stocks and bonds, trust or bank side, and I chose the stock side. And the rest was history. I basically, from there, managed pension money for Textron, was a senior VP, senior portfolio manager at Fidelity, running some big accounts out of London and Australia and Japan, running the US portions of global portfolios. Went from there, ran ITT Hartford's active equity department or portfolio, and then was a chief investment officer in New York for a billion-dollar firm. And then the other half of my career, really starting in the mid 90s or late 90s, was as a investment strategist, macro strategist, and I've been that ever since. And
Okay.
so it's been a nice, a lot of strategists I think come from the sell side. They don't have the money
Okay.
management experience, so that helped me a lot, I think, in having that macro grounding from an early age.
Okay. So I'm guessing that most of your analysis, at least in the beginning, coming from having a finance degree, was based upon fundamental analysis. And I'm
Absolutely.
wondering, when you came in and you were mainly using fundamentals, that sometimes the markets ignore the fundamentals for quite some time until they finally kick in. When did you or do you blend technical work with your fundamental analysis, and when did you, if you did, start using some type of technical measurements for, to back up what you saw fundamentally? Because Jack Schwager once told me that, he saw the most danger in the markets was fundamentalists because the argument never goes away. The fundamentals could be right, but the market may not pay attention to them, and they don't have a place as a fundamentalist to say I'm wrong if it takes out this level or that level. So, did you start applying technical analysis after a certain period of years, and who might have influenced you?
Yeah, absolutely. I would say, early on, I am kind of a lifelong contrarian, so that helped. I learned pretty early on that the market was part fundamentals, part technical, and part psychology. And so, I would say the psychology part was a big influencer. Early, I learned that pretty early on. Coming in '73, I saw the top of the Nifty 50 market, and then
Right.
the what had been the biggest bear market until 2008-9 that we had seen in post World War II era. So that was a real lesson in terms of, you know, watching after your risks, understanding markets can go both ways. Um, and you're right. I was fundamentalist probably primarily early on, but I would say in the first few years, I started paying a little attention to technicals. And certainly by 78, 79, I brought in technicals as part of my process. Um,
Okay.
I'd say a guy like Bob Farrell was very
Okay.
influential early on.
Right.
And to this day, I look, because I really do combine fundamentals, technicals, macro, all of
Right.
it. And I'd say he's as close as anybody on the street in terms of knowing how to put it all together in a scenario. And so, definitely he was one of them.
Well, I marked the beginning of this bull market August 1982. I was actually short IBM going into it. And really, this has been such a prolific bull market with bears being right occasionally with, we had 2000, we had 2008, and, many people scarred from what happened in 2000 and 2008. And I think that was what was behind self-directed trading. People said, hey, if I'm going to lose 60% of my money, it's not going to be with a salesman at a brokerage firm. I'm going to do it myself.
Yep.
And so, that was the beginning of, you know, sting me once, sting me twice. I'm going to control my own money, of self-directed trading really taking off. So, your handle is interesting to me. And, with what your call is, you're still a contrarian because there
Mhm.
are a lot of people thinking that we are, in a peaking phase here, and your narrative is aggressive. Is 4,700 your target for this year?
Yeah, I usually put in a 4,700 plus, and I've been
Yeah.
pretty vocal about the fact that I'm not going to be surprised if my numbers prove conservative. My targets typically are minimum targets. I would not
Okay.
be surprised if we see 5,000
52.
this quarter. Um,
Wow.
so
Wow.
so I think we're approaching the the parabolic melt up stage that takes us right to the top in a hurry. So I would not be surprised. It could spill into the third quarter, but I think we're getting pretty darn close to what I call the top of a 39-year secular bull market that started in August of 1982.
Yeah, right,
And I, you can make the case that the bull market really started in 74,
right.
down at 575 or wherever
Yeah, it
we
was
got
in that
bottom down there.
500
Yep.
point range for how many years before it finally broke out?
Yeah, but I use 82 because 82 really marks the beginning of the disinflationary secular move from 15%, 20% inflation
Yeah,
down to close to zero, and ultimately what I think will be deflation, and interest rates from 15% on the 10-year down to what we saw this year, 40 basis points. So I think that coincides because that was when you started PE multiples moving the other way. And so I use 82 as kind of the bottom of the secular bull market, and I think 2021 is going to be the top of that bull market.
okay, interesting. And all being fueled by central planning. And is that the majority thesis on this?
Well, certainly not for 40 years or 39 years.
Yeah,
There's been real reasons for this move. It's been
2008.
disinflation. You take
Yeah,
inflation down from 20% to close to zero, and multiples go inverse to that. That's real. Earnings have had, they're starting certainly in the 80s, we began to really manage earnings, so there's a lot of stock buyback and financial engineering in it.
yes, yeah.
You can call that whatever you want to call it, real or not, but it wasn't all central bank planning, but certainly, that's part of it. We've got asset
The
inflation
last
because of all
13
the money.
years.
Yeah,
Yeah,
certainly.
but
Well, and even all the way through, we've had, definitely. You look and you grew the balance sheet, from 875 billion to 7.5 trillion in the last 12, 13 years. That's a big part of this for sure.
all right. So let me ask you this because you've seen a lot of seasons and cycles in the market, and a lot of people are making comparisons to the market to the dot-com era in 2000. I see the difference is that it was pretty isolated to the stock market.com stocks. This time around, it's happening in real estate, it's happening in commodities, it's happening in equities, it's happening in crypto. It's hard not to find parabolic advances across different asset classes. Um, uh, is that the beginning of a warning sign that we're in a blow-off stage now? This type
Yeah,
of
I
rampant
think
speculation?
I think very much you're seeing, a lot of assets get blown up. You create trillions of dollars and they have to go somewhere, particularly, as I have said before, the cycle, the economic cycle starts, from a recession. You basically pump up the balance sheet of the Fed. You create money. That money has no economic need at that point because the economy's down. So that money has to go somewhere. It goes to the stock market as the residual, or the capital markets as the residual of both bonds and stocks.
Yeah.
As the economy recovers, some of that money starts coming out and going into the real economy where it's demanded. So we are getting close to that flip over stage where it's not just a vacuum that money goes into the capital markets. So I think sometime within the next several months, money starts flowing from capital markets into the real economy. And that's the beginning of, I think, assets beginning to peak out and roll over.
Okay, so I know your view on the dollar, and the dollar is, could be the easiest sacrificial lamb to get out of this, right, David? I mean, if you're a bear in the dollar, you could still have nominal gains in a lot of things. It's almost invisible, except if you have to go out and buy anything, right?
Well, I'm not in the camp that a weak dollar is going to bail us out. I think it may certainly play a role in this blow off.
Yeah,
So for a month or two or three, it
yeah,
could. I think we're going to see the dollar down to 85, the dollar index down to 85, and probably down to 82 before Labor Day. So I think we're going to see this down sharply. So in that period, it can certainly, that's why I don't pretend to think 4,700 is a point in time correct call. We could see this thing do some crazy things, meaning the stock market in a very short time. So you could see it go from, from here to 5,000 or even higher, if you get the combination of a very weak dollar and more fiscal stimulus and the Fed continuing to provide money. So I think we're in that stage. I've used the term. Let me just finish this. I've used the term parabolic melt up throughout the last year for what I think this last stage is. And we've really been in a parabolic. You step back, depending on how long your chart is, you'll see we've gone vertical. But as you get closer, it doesn't look so vertical in the shorter charts. People are going to be surprised at what a true parabolic looks like. I mean, it's just going to be straight up. And so you can cover a lot of ground in just a matter of weeks.
Okay, so
I'm sorry, Dale. Hey, good morning, Dave. This is Blake Morrow. How are you?
Good. How are you, Blake?
Great. Hey, thanks for joining us today. And I just wanted to say we were having this conversation before you had joined us, and we were talking about, I haven't seen, and it's been years, obviously, except for what just happened in crude oil this last year, where we had this capitulation for the obvious reasons. But I don't think most people that have been around less than 20 years have seen what a parabolic complete melt up or just kind of a pure liquidation move. I don't think many people have seen that. Would you agree?
Yeah, I would agree. Yeah, people throw around the term melt up a lot, and I go, there really aren't a lot of melt ups. What we're talking about is an equity melt up. Real estate's had a big rally here in the last several months. Bonds have had a long run, but a true melt up, well, I would say maybe what we saw in bonds last March was some sort of a melt up, but melt ups are very rare. And yes, you can look at the 2000 NASDAQ run as some sort of a melt up, but this is a broad-based equity market melt up. I don't really think we've had one since 1929. I mean, this is going to be a rare thing.
Okay, David.
Yeah, I agree, and I just wanted to just comment. Thank you so much for being here and echoing those same comments that I was having just before you got here too. I think it's a really rare occurrence, but thank you.
You're welcome.
Okay, so David, what ends it? Higher yields?
Well, higher yields. I think more importantly, I think it's probably going to be a shrinking of the balance sheet. I think, you saw in Paul's conference call yesterday, he's starting to have people hold his feet to the fire or try to hold his feet to fire about when are you going to have to deal with this inflation. And he did his best soft shoe to say, not now. He's very transparent that we're not ready yet, because he knows the minute he speaks it, it's going to be trouble for the markets and make it harder for them to manage the economy. So
what pushes him? What pushes him to start reducing the balance sheet?
When inflation within the next several months, I think, but probably sometime this summer, is going to start ramping up towards over 3%, towards 4%. I think, at least, counting in the commodity side, and I think it's going to get very uncomfortable. And at the same time, if numbers come out where we have 8% plus GDP growth in first, second, third quarters, somewhere in there, it's an overheating in the economy that we're beginning to already feel, and a run up in prices that he can't ignore. So I think that we're not that far off time wise, but he's being very sincere, in my opinion, in terms of saying we're not there yet, we're not even close yet. In his mind, they're not going to have to tighten this year. In my mind, they're going to have to tighten by Labor Day.
Well, I mean, let's even talk about his relevance. 10-year yields went from 50 bips to, 170 without the Fed. So,
Right.
I mean, remember the guys they used to call bomb vigilantes?
Right.
Okay, so they've been buried for 30 years. I think there's some resurrection happening with them, and the Fed doesn't have to tighten for yields, especially on the back end, to reflect the inflation fears. Isn't that correct?
Yeah, that's exactly correct. I've said many times, interest rates are not controlled by the Fed; they're controlled by the market. So,
Right.
so I have a forecast out there of 2.5 on the 10-year and 3% on the 30-year this year.
Okay.
And I think that's where I think rates will go. I actually think we're headed for 120 on the 10-year first, in spite of this
Yeah.
backup of 10 basis
Right.
points the last week. So I think
Right.
we're heading for 120, and then you begin the
Third
inflation
wave.
concerns and
Yeah.
that. And what I
Yeah.
remind people is the Fed. When people say, "Well, the Fed's not going to pull any money out," I go, "Don't forget, last July they pulled $300 billion off the balance sheet." We were barely a couple months removed from the second quarter swoon, and they were willing to shrink the balance sheet because they didn't want to go too far. So I think you could see, if this thing gets overheated like I think it's going to, I think you could see as much as $1 trillion pulled off the balance sheet. And if they do that, that just puts pressure on rates. That puts pressure. It takes money out of the capital markets. I think that could be enough to really tip things over. And then once you get going south, I think people are going to be surprised at the speed with which this thing can unwind.
Will they do that, David, through matched sales, so that, market participants know that they're draining reserves when they do match sales instead of reverse
It's probably
repos?
going to be a combination, but I certainly think they'll do some match sales. Yes.
Yeah, and I have Brian Picard asking, how does the Fed pull 1 trillion off the balance sheet? How do they do
Well,
that?
yeah, it's repos. It's all that.
Okay.
It's basically, they're going to be selling bonds back to the dealer banks and bringing the money out of the system. So it's, go back to last July. Some of it will happen quietly. They're not going to announce it, I don't think, but Fed watchers will see it happening with some lag. And I think you could see that before Labor Day.
Okay, so that's interesting. We're going to have quite a fall to be, and just sell in May and go away again is not going to be a good philosophy, especially with what you're talking about. People
Yeah,
will
I think
yeah.
I think May and June may be upward fireworks, and that sometime this summer we begin the other side. Now, when I talk about, and again, I realize I could be off by months, but
Yeah.
I think the potential is there for a top in the stock market this quarter. And then people say, "Oh, you're changing your mind because now you're talking about a bear market starting in the third quarter." I go, you don't hit a top and go straight down. Tops
You have
can
to,
take several months. So,
yeah.
you could have both happen. You could have a top made this quarter, but really not start really rolling over until, 3 months later, 2 months
Yeah,
later.
you would
So,
need some distribution, right? I mean, it takes time to turn around a battleship that's been
yep.
going in one direction for 30 years.
And it's also a case where it happens in many different shapes and sizes, but most tops, you might have a step down of, 8 or 10% and rally back and retest the highs, or get, 3/4 of the way back to the high. So it's not we make a top tick and then you're down, 80%. It's gonna, I think it's gonna be, there's gonna be people on both sides of the equation trying to guess, is this a top or isn't it? Is this just a pullback? So, I think people think too linearly. They kind of expect everything to be bing, bang, boom, exactly as you see it,
Okay, so I'm wondering, where are people going to hide? And it'll probably be different asset classes at different times. Do you think the gold? I looked at some of your targets and what you think about, and some of your targets and levels you're looking for in currencies and gold and GDX. Does this participate with the melt up like it is now? And will those assets, inflationary assets, be vulnerable when the market peaks? It's like everything's gone up together, David. Is everything going to be liquidating out and declining together in your deflationary bust, except maybe cash?
Yeah, well, the actually no, the majority of assets are going to go down together. Yes, I think real estate will be hit. Junk bonds, corporate bonds will be hit.
Yeah.
The two things I think will go up in the bust will be the U.S. dollar. Once we get down to 82, I'm saying you could see a run to 120 or even 140, because
Wow.
I think this will be a global bust. And as hard as we're going to be hit, I think Canada and Europe are going to be hit harder, and maybe Australia. So, and maybe parts of Asia. So, so there's going to be, again, as typically happens, I still think the dollar is going to be the place where people run for safety. Relative safety. We're going to be hit hard, but I think people will say at least the U.S. we know is going to survive this. So I think
DJ said he will. DJ said he'll hide in the Caribbean with a well-stocked bar. So let me ask you this, Dave. And there's
let
a
me
lot
finish
of
one last thing.
Yeah, go ahead.
So that I don't leave it out. And the other asset that I think will do very well in the bust is U.S. Treasuries. So I expect the 10-year to go to zero. I expect the 30-year to probably go to a quarter or something close to that in the bust, because it's a deflationary bust. It'll be fast, but it'll tip us into negative inflation, I think. So we'll go from this inflation scare this year to actually negative inflation sometime in the next year.
Okay. And looking at all of this happening here, with what's happening in our country, and people are asking me to ask Dave the question from Q&A. I believe I am doing that. What's it going to be like? And with people already suffering, and things are good for a lot of people that own financial assets, and that big $2 billion or whatever lost by Bill Huang or whoever was running that hedge fund, that was in a bull market. Can you imagine what happens when the tide goes back out, if you could have those kind of losses in a good market, in a powerful good market?
Yeah, for sure. That's the tip of the iceberg. Just like we saw in 2007 when Bear Stearns had those two leveraged funds run into trouble. It was still another year before we really found out what that was the precursor of. So same thing here. I think that was, tip of the iceberg. And we will see much more. Keep in mind, we've got pension funds.
Yeah.
And we've got people leveraged up to the hilt in so many places. So the bubble's blowing up, is being blown up, meaning getting bigger. And when it pops, there's going to be a lot of pain. So,
do you think we're going to have a lot of social unrest after the bubble pops? What are you doing to prepare for it besides financial markets and positioning yourself there? Are you a prepper?
Let me make clear, because this. I want to separate myself out from
Jim Rickards,
the Peter Schiffs and Jim Rickards of the world. This is not the end cycle. This is not the we're down for the count. There is a recovery cycle after this that is big. As I say, this secular top in the equity market, but if you go down 80%, you can still come back from, let's say, 1,000 on the S&P. You can triple and still be far below the high mark, or even quadruple and be below the high water mark of this cycle. So there will be a cyclical bull market, just not a secular bull market after this. I am calling for a big, and this bust will be pretty much contained. Why I call it a bust, not a depression, because I think it'll be pretty much contained within a year, within 12 months time. So, you'll have the market down, let's say potentially 80%, and the economy down the biggest post-World War II we've had. but all contained within pretty much a year. So
Okay.
on the
Compressed
other side,
depression.
on the other side of that,
Yeah.
we will have the first big industrial-driven, inflation-driven global recovery we've had since 1970s. So it will not be a consumer-driven cycle. It will be very much something you and I are familiar with, but most people are not. And why will it be industrial? It'll be industrial because there'll be massive fiscal programs coming out of governments across the world.
Okay.
In China, it'll be Belt and Road. In the US, it'll be all the infrastructure spending, et cetera. And it will lead to a commodity cycle unlike any we've had in the history of the world. I mean, I expect oil to go to 300 plus, and this is all this decade.
Where does it go in the bus? Where does it go in the bus, David, before it goes to 300? You think we see?
I'm calling for oil. I'm calling for oil up to 75 this summer, and then down to $10 again in the bus.
Wow.
And then from 10, it begins to climb to 300 plus. And natural gas will go through the roof. Copper will go through the roof. All the metals, gold will go to 10,000, silver 300. And again, those are minimum targets. I think we go a lot higher than that probably.
Okay, so this is just a prelude of what's happening in soybeans and the grains. I mean, if you look at what the grains have done, and I talk about grains, Dave, and they could, Fed could raise rates and reduce their balance sheet, but they can't print corn, and they can't print wheat and beans. So isn't it possible that even though we have a deflationary bust, that we could still have high prices for necessities like food during that time?
Yeah, I think for sure. Since it's only going to be, if I'm right, that it's only be a year long. It's not enough time to really have it go 100% the other way. So I think certainly, I think the grains are hard to call in terms of the short term. The longer term is that this is the beginning of a huge run up in commodity prices of all kinds, including the grains and the livestock. So I believe that the Farm Belt will be the real estate sector of the next cycle. The coasts are going to suffer the hangover effects of this bust, and interest rates. If inflation's going, and I should say this, I expect inflation in between now and between the deflation of the next year and the end of the decade, I expect a full retracement of the last 40 years of inflation and interest rates. That means we go back to 20% inflation, we go back to 15% long bond, we go back to 20% T-bills, all before the end of the decade. So, wow. Yeah. And that's because of all this money. And by the way, in the bust, I think you're going to see the Fed balance sheet grow to 20 trillion plus. So with all that money, and again, the same thing all around the world, with all that money, you're going to jumpstart an inflation cycle like we've never seen.
I'll tell you what, David, what a great time to be alive. The trading opportunities are massive with your narrative. And I'm so glad I reached out to you on Twitter. I've enjoyed talking to you, and I learned from you today. And thank you for edifying our community with your macro views, David.
Yeah, thanks, Dale. Yeah, I sound like a crazy man with some of this talk and the volatility that I'm describing, but I think we're coming to the end of a super cycle, which I define as the points between two depressions, the 1930s being the last one, the 2030s being the next one. And this bust is a precursor of that, but it's not the depression.
Okay, so good news along with some massive swings in many different asset classes. You know what happens, David, when you survive an interview with me? No. You become my trading warrior brother for life. Hey. You can't get, it's like the mafia. You can't get out. You can't leave. You're my trading warrior brother for life. And I've really enjoyed talking to you, and hope that we could do this again.
Yeah, thanks, Dale. I really appreciated you having me on.
All right. Well, everyone, and you have no axe to grind. Do you want people to at least follow you? I mean, you could follow Dave on Twitter. You don't have a business model for this. You're a strategist for.
Yeah, actually, what I do have is that I do have an investment letter, a macro letter that I put out quarterly, and it's by subscription. So I do make money off of that. If people are interested in it, just direct message me on Twitter. And my Twitter handle is at Dave H. Contrarian.
What's the H stand for? Is that your middle initial? H?
No, H Hunter. H stands for Hunter.
Okay, Dave H. All right, Contrarian. It really was eye-opening to hear these narratives and the kind of swings we're going to have, and fortunes will be made and lost. And what the Chinese say about a crisis, it's danger and opportunity. And the danger is you miss the opportunity. And I think you've opened our eyes to the massive opportunities that lie ahead. Thank you so much, David.
Yeah, that's better than that's better than your former mayor said, where we never let crisis go to waste.
All right, so everyone, don't just count your deflationary busts or inflation runaway. Count your blessings, and remember that pips come and go. Time is gone forever. Make it count, and as we are living in interesting times. So, again, David Hunter, thank you for joining us on F.A.C E. It was enlightening for everyone that heard you today.
Okay, thanks, Dale. Thanks for all the good questions.
All right. That's a wrap, everyone, for Thursday. We'll see everyone for TGIF. And you could join the team for the Morning Edge in 7 minutes. Adios, everyone. And thanks again, David Hunter.